Good morning, everyone. Welcome to Phillip Securities Research Morning Call for 12th of August 2024. For today, we have quite a few stock counter and technical analysis updates. And as usual, we would end the session with Singapore Weekly. So let us get started. This is a gentle disclaimer that the webinar is just for educational purposes. So let's start with the Block second quarter 2024 results. So Block basically is a fintech company and it operates through two segments. Cash App, which basically provides banking services to individual customers. For instance, like a savings account or a debit card, or it can also offer services like peer-to-peer payment transfers. And also through Cash App, the users, they can invest into Bitcoin. So they basically charge a certain percentage of fees for the transactions for the cryptocurrency transaction, or like if they use a debit card for the ATM withdrawals. So they charge a particular percentage of fees. And the second segment is the Square segment, which basically offers hardware and software solutions to merchants to accept payments from the customers when they place their order. So overall, the results in terms of results, the second quarter revenue, it was within our expectations, whereas adjusted PATMI, it came in ahead of our estimates, mainly because of high operating leverage. So in terms of positives, the cash up segment gross profit, it grew by about 23% year over year. And this was mainly led by a 6% growth in its monthly active users, as well as high engagement. So the company, it highlighted that the monetization rate, it basically increased by 9 basis points on a year basis to 1.53%. So this basically highlights that the existing customers, they transacted or they adopted to their banking services more. And as an example, the number of debit card users, they grew by about 13% year over year to about 24 million users. Of the 57 million total, they used their debit cards. And moving on to the second positive, the companies, it has been focusing on improving its earnings. So its operating income, it reported a positive operating income of 307 million. And this is mainly because of the focus on cost efficiencies. And as a result, the operating expenses, they dropped by about 4% year over year, and mainly through careful sales and operating expenses. And in terms of negatives, the Square segment, it reported decelerating growth rate for its gross payment volume on its platform. So it reported gross payment volume of about a growth of about 8% on a year-over-year basis, as compared to 12% the previous year. And this is mainly because of the soft consumer discretionary spending, particularly in the areas like food and beverages and retail categories. So, in terms of outlook, the company, it raised its total consolidated gross profit outlook to about $8.9 billion from $8.8 billion. And the upside, it was mainly because of the strength coming in from the cash app segment. And whereas the highlighted that in the second half of 2024, the Square segment gross profit growth rate, it should more or less remain stable as compared to the second quarter of 8% growth rate. Meanwhile, the company, it also increased its outlook for adjusted operating income to about 1.44 billion US dollars from 1.3 billion dollars, and this is mainly because of the continued focus on high operating leverages. In terms of valuations, we maintain a buy recommendation, but we slightly increase our target price to $100. And this is mainly because we maintain our FY24 revenue estimates unchanged, whereas we slightly increased our adjusted PATMI by about 4%, mainly to reflect low expenses. So in terms of for Block, we believe that it should continue to benefit from its margin expansion, as well as the secular shift to cashless payments, and also it's a unique proposition wherein targets basically the underbanked or lower income population. So overall, we have a buy recommendation for Block. So that's all for me. I would now like to pass it on to Helena for Amazon.
Thank you, Ambrish. Let's move on to Amazon. So Amazon's second quarter result was in line with our expectation. Next slide, please. The main highlight is their AWS strengths, which grew 19% year over year. Pretty good acceleration, better than expected. So consumers are continuing migrating their workload from on-premise to cloud. Another thing worth mentioning is their margin expansion, which increased 4.2% year on year to 9.9%. Their margin strength is due to the scaling up of AWS and advertising, both higher margin businesses, as well as Amazon's improvements throughout the network that helps to further lower down their costs and improve their delivery speed. Moving on to the positive and negatives, AWS continued to accelerate. It is driven by consumers shifting from on-premise to cloud, also because of the rising demand of AI services like SageMaker and Bedrock. Additionally, there have been strong demand for their custom AI chips, which is considered very cost-effective. We expect to see continued acceleration for AWS in the second half. Another one would be their rising capex in AI. So Amazon's first half of FY24 capex was 30.5 billion, and they have just guided that it's going to be a further increase in the second half of the year. Just to put in comparison, their entire year in 2020 FY23, the capex was 52.7 billion. So there have been this popular debate on whether all the tech companies, their high spending the AI is good or bad, whether it's worth it at all to spend on it. In Amazon's case, we think yes. They are seeing strong signs of high future demand. They have a backlog of 156 billion, which is larger than the current revenue run rate. And also the lifespan of AWS server is typically 5 to 6 years. So definitely it's long-term investment necessary to scale up the services. So we think it's reasonable, especially since all the tech peers are investing heavily in AI. Moving on to the negative, pullback in consumer spending still persists. In the last earning, they have already hinted at potential signs of a slowdown, and the trend continues. But if we take a look at Amazon's Prime Day sale, which happened in July this year, it actually reached 14.2 billion, which is an 11% increase from last year. So in our view, yes, there is a slowdown, but a slowdown doesn't mean negative, just slower acceleration. So overall, it's still pretty resilient. Management has also indicated they are already observing strong unit volume growth in the last quarter. In terms of guidance, they have guided the third quarter revenue year-on-year growth of 8 to 11%. Operating income expected to be between 11.5 to 15 billion US dollar. Their margin should be not moving much, 7.3 to 9.3%. And of course, they're increasing to increase their capex. We think growth momentum in AWS is still pretty strong. Before cost cutting, their peak was at high 30%. So in terms of moving on to cloud, we're still at the very beginning stage. So we think once the cost cutting effect completely wean off, we should see it keep going up to the previous peak growth rate. And this is going to outshadow the slowdown in consumer spending. So overall, we still maintain our buy rating with a target price of 220 US dollars. Okay, moving on, my next counter will be Apple. So Apple's third quarter result was also in line with our expectation. The growth is led by strong service business, which grew 14% year on year. However, China market remains weak, and we're still not seeing any spark in iPhone sales. To talk about the positive and negative, the positive is they have pretty strong gross margin delivery. The third quarter gross margin is 46.3%, which is increased by 1.7% year on year, which is at the high end of their guidance range. The margin expansion was primarily driven by a favorable shift towards services, which is a high margin business. Services now they account the overall revenue mix of 28% right now compared to 1 year ago, which is only 25%. I mean, to put in perspective, service gross margin is 74%, while product margin is only 35%. So we do expect continued strong margin expansion for Apple, considering their service is growing quite strong. Moving on to the negative, we have pretty weak sales in China. The revenue from China contracted 6.5% in this quarter. Usually when they say China market is not doing good, they will point out how it's not really the iPhone, but other products that's not doing good. But this time they didn't even bring it up. So we're kind of taking that iPhone weakness remain a key drag. So the company does continue to face challenges from local competitors. And we believe the ongoing weakness in China market will continue to hamper the product growth, especially given there are lack of plans to introduce Apple Intelligence in China anytime soon due to regulative issues and the Chinese version not being available yet. Another negative point is the iPhone refresh cycle will have to wait. We kind of expected to start rolling out in the last quarter of FY24, but that does not seem to be the case as they have projected only a 5% year-on-year revenue increase for the next quarter. So if you do simple math, you deduct the double-digit growth in services and the growth in iPad, that kind of suggests flat or potentially negative growth in iPhone sales. So it's unlikely to happen in FY24. We think the refresh cycle is probably going to be FY25 and FY26. Also, they also plan, they say they're going to roll out Apple Intelligence gradually. So that kind of also delay the timing. So we cut our FY24 iPhone unit estimate by 5% to account for the delay in iPhone the cycle. In terms of guidance, they only guided single-digit growth for their overall revenue, which kind of hinted that iPhone sales is going to remain flat. So we kind of cut our iPhone unit estimate and cut our revenue and PEMI by 5% and 1% respectively to account for the delay in iPhone refresh cycle. And overall, we maintain a neutral rating with a slightly decreased target price of $215. That's all from me. Now I might pass my time to John.
Yeah, thanks, Helena, and good morning, everyone. So I'll just be doing a quick Phillip on the ground for Uber Technologies. Next slide, please. Just to reiterate, we don't have any coverage, so it's a non-rated presentation. So basically, in case you didn't know, Uber is just like essentially Grab. Although significantly larger, they have 135 billion market cap. We'll just be covering some brief snippets from their second quarter results that they issued last week. Overall results quite positive. There's a lot of earnings growth as well as bottom line growth. Just to put in context, Uber also recently, I guess, in the last 1 or 2 years, became profitable on their bottom line. So they're seeing a lot of benefits from that in terms of scale. The key thing that was really driving results were bookings as well as more users and more trips. You can see in this first bullet point here, gross bookings about 20%, trips about 20%. Essentially, the key thing for Uber is that it's really operating in a winner-take-all environment. Their main competitor, at least in North America, is Lyft, and Lyft, I think, has about 10 or 15% market share. And so where Uber positions itself is usually the main kind of mobile ride-hailing platform, deliveries platform. And we think that is likely going to be the case for this industry, whether it's Uber or Grab or whoever is in the marketplace. The key things that we found quite interesting is that their mobilities and deliveries take rate. You can see here in bold 30% and 18%. If you compare it to just Grab, Grab's mobility take rate is about 20%, and the deliveries is about like 12%, 13%. So significantly higher. There's several reasons for this. Firstly, they operate in mainly developed markets, and so they're able to charge a little bit higher. Also because they are the dominant player, so competition is a little bit less. And B, because they are so much larger, they've got 150 plus monthly active users. So they're able to charge a little bit more. The things that were quite interesting, well, aside from our outlook was still very positive. But the thing that was quite interesting is that they're actually partnering with BYD to bring in about 100,000 new EVs onto that platform. And so this is kind of in preparation for the Uber drivers switching over to EVs, because what they mentioned is that Uber drivers, because they travel a lot more, they consume a lot more petrol, they switch to EVs 5 times faster than normal drivers. At the same time, they also do travel about 5 to 6 times more than normal drivers. So at least for a lot of these delivery drivers or mobility drivers, it makes a lot of sense to switch over to EVs because of the cost savings that they can have. The second very interesting thing is that they're partnering, or they're in talks with several autonomous vehicle companies to actually bring them onto Uber's platform. And they're actually highly confident that they'll be able to acquire a lot of these, as it bring these guys onto the platform in future, especially as autonomous driving, autonomous taxi kind of heats up in the US, at least, and in China. So just some interesting points to note, because that may provide quite significant revenue growth opportunity because they are just a platform, right? So everything aside from their fixed costs, every other revenue they can bring in, they just take a cut, and it just kind of drives volume. Yeah, so overall, very good quarter for Uber. They continue to grow both their top line and bottom line. We expect this to continue moving forward because of their dominant position. Yeah, so that's all for me. I'll maybe hand over to Glenn to continue with the banks. Thank you.
Thanks, John. Yeah. So for the banking side, we're starting off with DBS. They released their results last week. Yeah. So the second quarter results, it was slightly above our estimates. I think this mainly came from the higher net interest income, fee income as other non-interest income, but was offset by higher expenses. So their first half, for the second quarter, their DPS was raised 23% year-on-year to 54 cents, but the dividends were flat quarter-on-quarter. So jumping straight to the positives, first one is that their net interest income continued to rise from loans growth and deposit growth. So loans and deposit grew around 3 and 6% respectively, but the NIM was commercial book NIM was higher. This mainly came from the fixed rate asset repricing, but group NIM did slightly, mainly due to the deployment of their assets and deposits into lower yielding, high quality assets, which were actually accretive to earnings, but diluted the NIM slightly. As for the second positive was that their wealth management continued to lead the fee income growth. So wealth management grew as there was this continued shift from deposits into investments and bank assurance, as well as expansion in the assets under management. So basically all the factors were in their favor for wealth management. And card fees also grew as well as loan-rated fees. For the last positive was that their credit costs and their specific provisions improved. And this was mainly due to a dip in their specific provisions as the new NPA formation were more than offset by higher upgrade settlements and recoveries. So they also said that none of the new NPA formation was idiosyncratic and did not see any particular stress in any sector. As for the negatives, the first negative was that their expenses climbed up, mainly due to the salary increments as well as higher bonus accruals and headcount growth from the addition of staff from the City Taiwan. As for the second negative is that their CASA ratio decline continued. It fell around 6 percentage points year-on-year to 50%, mainly due to this high interest rate environment, as well as a continued move towards fixed deposits. As for the outlook, we feel that their GP reserves are sufficient, and with their capital position and liquidity well above the regulatory requirements as well as high allowance reserves, we believe that DBS does have the sufficient provisions to ride out current economic uncertainties. For their CET1 ratio, it rose 10 basis points Q-on-Q and 70 basis points year-on-year to 14.8%, and is also at the upper end of their target operating range of 12.5% to 13.5%. I mentioned earlier about their dividends, which was flat quarter-on-quarter. So they did say that there is a need to return capital and hinted at the possibility for further increase in dividends, but did not confirm how or when it will be done. Piyush mentioned also during the call that he did not want, there was no increment in dividends for this quarter, as they did not want to take away the sort of the limelight away from the handover to the new CEO, or more like the appointment of this new deputy CEO and his future successor. Fee income recovery will be maintained, so they have maintained their guidance of double-digit fee income growth, which the wealth management as well as credit card fees will sustain. It has grown by double digits in both the first quarter and second quarter, and we should see the same momentum in wealth management going into the third and fourth quarter. And this is also mainly due to this shift in investor sentiment I mentioned earlier. As for their net interest income and PATMI, DBS has increased their guidance provided in the previous quarter. So now they expect their net interest income growth will be the mid-single digit, and with a sensitivity of $4 million per basis points of the Fed rate cut. And this net interest income will be supported by the continuation of fixed asset repricing in the second half of the year and some trade-off between net interest margins and loans growth. As a result, we are expecting for PATMI growth of mid to high single digit for FY24. We do upgrade to a buy with an unchanged target price of $38.50 as we account for the recent share price performance, while our FY24 estimates remain unchanged. We expect stable growth in net interest income from the continued fixed asset repricing, and deployment of deposits into longer tenure income, accretive interest earning assets, while loan growth to recover from the rate cuts in second half of the year. And the double-digit fee income growth will also give a further boost to earnings for DBS. So that's all for DBS. I'll now move on to SGX. The next slide, thanks. So SGX released their second half and their full year results. The revenue did meet our estimates, but the adjusted PATMI was slightly below, as the variance came from the lower equity derivatives revenue as well as lower treasury income. For their dividends, the second half dividends was increased by 6% year-on-year to 17.5 cents, while full year dividends is at 34.5 cents, up from 32.5 cents from the previous year. Now, for the first positive being that their FICC, currency and commodities, continues to grow, and it was a main contributor to growth, led by an increase in the commodity derivatives volumes from higher volumes in iron ore derivatives, as well as an increase in the currency derivatives, as well as in the increase in the USD CNH FX futures contracts. Their OTC FX line business also showed steady growth, with their FY25 target of $100 billion reached early. They actually achieved it in the FY24 at $111 billion. But SGX did not provide any new guidance for this target and mentioned that the aim would be to maintain the current levels. So I think they're just trying to maintain it above $100 billion. As for the second positive is that their market data and connectivity revenue rose, and it was driven by repricing as well as increase in number of data license subscribers. As for the negative, the biggest negative there was that their treasury income has declined, and we are starting to see this rather steep decline. So second half total treasury income fell by 24% from the previous year's record levels. And this decrease was mainly due to lower average yields on margin deposits, in addition to a decrease in the margin balances. Second negative is that their derivatives volumes and fees has continued to fall. So the volumes fell as the volumes of their two largest contributors, the GIFT Nifty as well as the FTSE China A50, declined. And the fees were also lower, mainly due to a decline in average fees of the Nifty 50 index futures. As for the outlook, the OTC FX business will be the main growth contributor. So it has continued its strong growth, and as I said earlier, they have achieved their target, FY25 target early, and it's well positioned for growth. And SGX is also quite cautious for the near term. They have guided for lower FY25 expense growth of 2 to 4%, and in a similar range of low to mid single digit for the medium term. These higher expenses are mainly from the build-up of their OTC FX business, as well as higher staff costs from salary increments. As for the capex wise, it's expected to be around 70 to 75 million, so slightly higher from this year's 66 million, mainly to modernize their technology. And lastly, for the last point for the outlook is that their interest rates will now be a headwind for SGX. They managed to sort of ride the wave, the interest rates are high previously, and saw that in treasury income just increased without really doing much. But now it's expected to dip with the expected interest rate cuts in the second half of the year. So notably, their yield has shown a big decline from 109 basis points in FY23 to 103 basis points for FY24, as the interest rates on the fixed deposits as treasuries start to drop globally. So we do believe that SGX will face headwinds as treasury income has started to decline, even though rate cuts have yet to materialize. And we could see a steeper drop when the rate cuts start to come in the later part of the year. We do maintain accumulate with a higher target price of $10.78 as we increase the FY25 earnings from higher FICC currency and commodities and market data and connectivity revenue estimates. We expect SGX to maintain stable growth from currency derivatives volumes and its OTC FX business pillars as they acquire new clients across Europe and Asia Pacific, while keeping their expenses growth contained. However, they do face headwinds to treasury income from the expected rate cuts in the second half of the year and continued decline in equity derivatives volumes. So that's all I have for SGX and the banking side. I will now hand it over to Miao. Thanks.
Thank you, Glenn. I'll go through Elite UK REIT. They released the second quarter result of first half result last week, and the results are mostly in line with our expectation. For positives, leasing momentum in UK is picking up. Elite has successfully extended the lease for one property by 10 years with rental reversion of 32%. Although the contribution is only marginal to the revenue uplift at the portfolio level, it serves as a positive indicator that the office leasing momentum in the UK is actually bottoming up. And the portfolio valuation maintained stable, increased by 0.6% year-on-year in first half 24, thanks to several redevelopment plans unlocking the property value. And we expect Elite to increase its payout ratio to above 90%, as its balance sheet has been substantially strengthened and will continue to improve with the lower interest rate. And for negatives, in first half 24, NPI was supported by the 1.5 million dilapidation settlement, leaving only one dilapidation settlement remaining before exhausting its revenue top-up source. The 7 vacant assets continue to exert downward pressure on the top line. So we do not expect any acquisition in the near term due to the high interest rate environment in the UK. And Elite's objective is still to keep the gearing down below 40%. So as a result, DPU might face further erosion. And furthermore, although the cost of borrowing was flat in the first half 24, was at 5.2%. We expect all-in cost of borrowing to increase to 6% by the end of this year. So there will be another year of interest rate headwinds. And for outlook, divestment is still progressing well for Elite. And we expect the momentum to pick up soon, given the Bank of England just cut its rate. And we expect Elite to divest around 3 to 4 assets from the 7 vacant properties, which would worth around 6.5 million. And the price is expected to be at a premium above valuation. And Elite is also confident in the potential redevelopment plans. Additional power was secured for one of the data center project, and more detailed plan will be released by the end of this year. And we believe there's more opportunities coming out, as the UK just abolished the planning process and grant right for all the office properties to be converted into residential properties. And given the shortage in the residential supplies in the UK, it is well positioned to generate better yield from these conversions. And we maintain a buy recommendation with unchanged DDM-backed target price of 0.32 pounds. And Elite is currently trading at attractive FY24 dividend yield of 11.3% and price to NAV of 0.63 times. Yeah, next slide, please. And moving on to Lendlease Global Commercial REIT. So Lendlease released the result last week, and the result was in line with our expectation. Singapore rental reversion in FY24 achieved 14% year-on-year growth, and Sky Complex also saw a CPI-linked rental uplift of 1.2%. We expect catalysts to come from both GEM and Sky Complex. A rental review for GEM office in December 24 is expected to yield around a rental reversion of 5%. And Sky Complex is expected to be fully backfilled by second half 25, with rental reversion of around 30%. Altogether, this is expected to boost the revenue by 2 to 3% for the upcoming financial year, if the leasing momentum in Milan sustains. And despite a 10% asset devaluation in Singapore dollar for Sky Complex, the property valuation still, the overall portfolio valuation still improved by 0.9% year-on-year, with GEM leading the performance, which increased by 3% year-on-year, and 313 at Somerset achieving a 1.3% uplift. We expect valuation to improve in the face of the ongoing rate cut in Europe and also backfilling of Sky Complex building. And for negatives, strong SGD has been challenging the market expectation for the sustainable tenant sales. REIT has observed fading demand from both foreign visitors and also local shoppers. Since Singapore dollar remains strong, more shoppers choose to spend overseas, and it also hampers the inbound shopping. Although sales continue to trend above pre-COVID level, is at 111% in June 24. There's still remain a 4% gap in terms of traffic. Yeah, so that is needed to be addressed. So to add on pressure to the rental reversion in FY25, we believe that all the low rent signed during the COVID period will be phased out by the end of 2024. So as a result, rental reversion in FY25 is expected to be at the high single digit level. And for outlook, REIT is currently marketing Gem office property, and its most recent valuation is around 450 million to 480 million. We expect gearing to decrease by at least 8.1%. Yeah, assuming divest at 450 million. Yeah, as the valuer hasn't incorporated the result of the rental review, we expect higher premium to book value upon successful negotiation. Inquiries has been increasing since Maypac's recent transaction of the Anson building, with around 10 prospects currently interested in Gem office. The occupancy rate for Sky Complex has improved from 8.1% to 22%, with rental reversion exceeding 50%. Demand is still strong for Sky Complex, as it's a green certified building, and is located at Italy's only green certified district. And several tenants are under the negotiation stage, with some of them looking to occupy 1 to 2 floors. However, due to the prolonged decision making, we expect the building to be backfilled by calendar year second half 25. So we revised our DDM back target price from 0.83 to 0.8 and lower our FY25 to 26 DPU forecast by 10%. Taking into account of the higher interest expense and also fading recoveries in demand. So REIT is currently trading at FY25 dividend yield of 6.9% and price to NAV of 0.76 times. And next slide, please. Yeah, so moving on to Sasseur REIT. Something positive about Sasseur is their cost of borrowing is decreasing. It decreased by 0.3% year-on-year to 5.3% in first half 24. And Sasseur has hedged 100% of its USD denominated loans at cost of 3.6%, which is significantly lower than the floating rate. And more interest expense saving are expected to come from the onshore borrowing, as China loan prime rate is continuing to trend downwards, and Sasseur has not hedged any of these borrowings. So we expect borrowing costs to continue to trend down, and Sasseur may be the one of the first REIT to recover from the interest rate headwinds. And something that is hurting Sasseur the most is tenant sales is declining. Tenant sales in second quarter 24 fall by 28% year-on-year due to the high base in FY23 and also a decrease in willingness among Chinese customers to spend on high-ticket items such as the international brands. There's a domestic brands, sportswear, and the young-focused fashion brands are gaining the most attention and reflecting the purchase power of the younger generations in China. Sasseur has been improving its product and also price mix by offering more attractive discounts on the outdated products to remain competitive in the intensifying price war in China. And we expect stronger performance in second half 24, as in the first half, particularly in second quarter, is typically weaker due to seasonality. And for outlook, Chinese consumers are becoming more cost conscious due to the slower economy, and VIP members continue to drive the highest sales. And Sasseur has launched several loyalty programs and VIP benefits to attract the VIP members. So VIP benefits such as the step-on discounts. So that's the VIP discount on the top of the regular discount, and also early access to some of the sales events. So the key strategy for Sasseur is still to provide more competitive pricing as consumers are becoming more selective. So we expect margin to be compressed further, but this will be offset by higher sales volume as a trade-off to capture the greater market share. So we maintain a buy recommendation and unchanged target price of $0.87. Sasseur is trading at FY24 dividend yield of 9.2% and price to NAV of 0.8 times. And that's all for me. I'll hand over to Darren for Cromwell. Thank you.
Yeah, thanks, Mel. Yeah, so for Cromwell REIT, yeah, we expect positive revisions to continue for the rest of this year. So the results for the first half were in line with our expectations. The revenue was down slightly, mainly due to the asset sales, but NPI was up 2.3% on a like-for-like basis due to positive rental reversions and rental escalations. And as a result of slightly higher net finance cost, DPU was down about 9.5%. So first half DPU is 7.05 cents. So for the positives, the portfolio occupancy, it remained high, 93.6%, so it improved 20 basis points, mainly because of Nervesa 21 now is fully leased, so it will start contributing in the second half. So Nervesa 21 was one of the properties that just completed its redevelopment. Yeah, so the light industrial and logistics property, the segment, the occupancy is at 94.8%, so it improved slightly, 30 basis points, and the office improved by 100 basis points to 90.7%. Yeah, so right now, this is the first time that Cromwell, they gave this data that the portfolio is under rented. So under rented means that basically the passing rents at their current portfolio are lower than market rents by 7.4% and 4.1% for light industrial and office respectively. So as a portfolio, their total portfolio is under rented by about 6%. And the all-in interest rate of 3.16 for this quarter is down slightly quarter on quarter. And it also lagged Euribor's rise. So since 2022 June, Euribor has risen by 400 basis points, but due to Cromwell's high hedge ratio, basically their interest rate or their all-in interest cost only rose by 172 basis points as compared to the 400 that Euribor rose by. So as of today, 88% of their debt is on fixed rate. The next debt that's expiring is the bond that expires in November 2025. So they'll try to delay that as long as possible to make use of the cheap cost. Because right now that bond is only paying a fixed rate of 2.1%. And right now their gearing is still healthy, 40%, and their all-in cost of debt is expected to remain at about 3.2% for the rest of this year. But next year, when they refinance the bond, they expect it to increase to about 4%. Yep, and for the next positive is that their portfolio valuation for the first half of this year has stabilized. It rose 0.6%. The light industrial and logistics portfolio valuations, it improved by 2%, while the office portfolio valuations, the decline is slowed by -1% or -1%. And this slowed from -4.6% decline in December 2023. So we are also seeing some stability there. Cap rates have stabilized, but over the past 2.5 years, cap rates have risen by 150 basis points, while Cromwell's, their portfolio valuation only decreased by 3.5% since then. And this definitely has outperformed all of their overseas counterparts. Yep. And for the outlook, Cromwell's poised to benefit from more ECB rate cuts. And right now, since their gearing is maintained at around 40%, they think it's a healthy level already, and the fact that portfolio valuations has also stabilized, excuse me, so that the risk of any gearing breach due to asset devaluations is not as high anymore. So Cromwell, they plan to decelerate its divestment strategy. So right now they have about 90 million euro worth of assets that are left in the pipeline. Is down from 150 million quarter on quarter. So the remaining 90% is mainly from the weaker Polish and Finnish office assets. And when they divest this, it will also help to bring Cromwell back to towards their target of 60% in light industrial logistics and 40% in grade A office in the longer term. So right now, the focus for Cromwell, they have to maintain that is basically the managing of the November 2025 bond maturity, and also maintain high occupancy and high rental income growth by having good reversions, and also completing this remaining 90 million of assets. Yep. So no change in our target price. Maintained buy call DPU yield of 10.2%. That is this forward this year, and FY 2025 DPU yield of about 9.7%. So that's our forecast. After the interest rates, after taking into account the higher interest rates from the bond, and Cromwell is now paying a price to NAV of about 0. Cromwell is trading at a price to NAV of 0.65 times. Yeah, next slide, please. Yeah, I'll now run through a Paragon REIT. So they released the results. We also hosted them for Phillip on the ground. So basically, Paragon REIT is a retail REIT with assets in Singapore and in Singapore and Australia. So their biggest mall and biggest contributor is Paragon in Singapore, the Paragon Mall. So the revenue is up. NPI is also up 4.5%, but the distributable income is down, mainly due to the management fees being fully paid in cash as well as slightly higher interest expense. So last year, their management fee, they had a mix, like first quarter was 95% and 50% paid in units. But now they fully paid in cash, which is why the DI is down 14.5%. But they use some previous retained capital as well to top up the DPU. So DPU is actually not down 14.5%, it's down like 3% because of they're paying back some of the capital. So for some of their capital management, on the capital management front, their all-in cost of debt remains 4.6%. Gearing is still healthy at 2.6%. Yep, and one more thing to note is that they've indicated that they'll fully redeem the 4.1% $300 million perps. So this is the first call date, 30th of August 2024. So they redeem that to save on interest costs, as if they reset the perps on the reset date, which is 30th of August, they will pay way higher interest. So definitely makes more sense for them to recall back. So for portfolio occupancy and retail rental reversions, right now portfolio occupancy is at 98.1%. The Singapore properties are 100% occupied. Portfolio rental reversions for Singapore is very strong. Yep, it's at 22.5% for Paragon, 19.1% as a whole. So they also announced that they're divesting the Real Mall. So they're divesting it at 26% above valuation. So they'll use some of these proceeds to pay off some debt and perhaps fund some potential acquisitions. Another thing that we want to highlight is that the tenant sales. So tenant sales for the Australia properties and as well as Clementi Mall, which is considered a suburban mall, has been very resilient. The suburban mall, Clementi Mall, the tenant sales improved, could be attributable to the CDC vouchers. But for Paragon, it's down about 7%. So the management, they indicated that this could be due to the fact that they've been doing some renovations and some movement in tenants around the mall. But so we have to monitor to see whether this tenant sales decline will continue into the rest of this year and maybe next year. But the thing we want to highlight is that right now the Chinese spenders are still low. So Chinese visitor arrivals are still about 20% below pre-COVID levels. And on top of that, the Chinese economy is not doing well. The consumption spending is also not doing too good. So even if the Chinese come back, they also might not spend as much as pre-COVID time before the property crash in China. Yeah, so for the valuation wise, Singapore's valuation has been stable. No change in cap rates. Improvement in operating performance resulted in about 3.5% valuation uplift for the Singapore assets. For Australia, there's a slight expansion in cap rate, so that is why the valuations declined slightly as well. But for their outlook, despite the tenant sales slowdown, they've indicated that the tenants are willing to pay higher rental reversions because, in the view of the tenants, that the outlook for tenant sales can continue to improve and is still very strong. So that is why they are willing to pay higher rental reversions. So we also can expect strong rental reversions going forward, but maybe not at a 20 level, maybe high around the teens or high single digit going forward. And right now, Paragon REIT is paying about 5.3% dividend yield. Yeah, so that's all for highlights for Paragon REIT. And I know the time to say thanks.
Thanks, Darren. Good morning, everyone. I'll move on to the technicals. Next slide, please. Yeah, so first I'm looking at S&P 500. Last week, we opened around 5,000, below 5,200, which did a retest of the previous swing low, formed in the end of May. And afterwards, throughout the rest of the week, there was a bit of a rebound. For this week, we are likely to see some consolidation ahead as price could retest the 5,400 resistance area, which was a breakdown in end of July. So with that, the immediate resistance is at 5,375 to 5,445 area, with immediate support at 5,195 to 5,265 area. Next slide. So this is just to look at the market volatility that happened last Monday. So last Monday, we actually saw the VIX spike to its second largest, which was the second largest single day percentage change at 64.9%. The last time the VIX surged higher was 115%, which was recorded in February 2018. Yeah, so this is the second largest rate of change in the VIX history. Next slide. Yeah, then we also looked at how the S&P 500 did when there was a large spike in the VIX. So we looked at a top 10 single day rate of change for the VIX, and then the 1 to 12 months returns for the S&P 500 afterwards. So the market has actually done pretty well following such large bouts in volatility. The typical 1 month return is about 1.9%, 3 months is about 4.6%, 6 months is at 8%, and 12 months is at 11.9%, with about 80 to 90% probability of the market being in the green after such a volatility. Yeah. Next slide. Yeah, then also last but not least, we looked at the historical drawdowns for the S&P 500. So currently the drawdown is about 5%. The peak drawdown in this current stretch is about 9.7%. So currently we are still in a pullback, which happens about 3 to 4 times in a year. Yeah. Then when look in terms of correction, which is a 10% drawdown, that occurs about once every 2 years. The last time we saw a correction happen was in October of last year. And then even more severe drawdown would be the bear market, which is around 20% from the peak to the trough. The last time the bear market was recorded in October 2022. Yeah, so this is just to look at how the current drawdown compares to the previous drawdowns for the S&P 500. Next slide. Okay, next one, we have a technical buy on Chipotle Maximum Grill at $55.11. Take profit levels at $59.50 and $62.50, with a stop loss at $52.60. The stop loss goes at $55.55 on Friday. So looking at the chart, it actually formed a double bottom recently, and then the price broke out of a downtrend channel resistance. Currently, it's also above the $54.50 neckline resistance as well. So you see potential bullish reversal taking place, accompanied with the bullish divergence and increasing momentum at MACD. So price could do a rebound towards these two take profit levels, which were prior resistances. Next slide. Yeah, so this is to summarize the trade initiated. Currently, it's up about 0.8%. So that's all from me now. I'll hand over time to Paul to talk about ThaiBev. Thanks.
Yeah, thanks, Dean. Move on to ThaiBev. They came out with the third quarter update. There's no analyst briefing and there's very limited financials given, just revenue and EBITDA. But in general, the results were within expectations. You'll notice that EBITDA is higher than our run rate of 75%, but mainly because we think the associates and also higher interest rate will kind of pull down their earnings. So that's why we're not going to adjust. So in general, the positive was beer. So if you look on the table on the left, you'll notice the beer is up 16%. This is the second quarter of improvement in beer. The negative for spirits, spirits is the biggest, probably 70-80% of net profit. Not EBITDA, because there's minority interest, because they don't own all of the Sabeco. It was a tough cons because last year there was very strong numbers, so that's why it's weaker now. No change in our profit or buy recommendation. For this year and the next few quarters is all going to be beer. So beer will be the one that's going to pull earnings because of the recovery in Thailand and Vietnam. The only pullback is that the competition in Vietnam is starting to increase, but if the volumes pick up, then that should kind of improve. But for us, our general view of this stock is that because ThaiBev already has like 95-96% market share in the spirits business. So for them to resume growth, you really need stronger macro conditions in Thailand. So that's why our last bullet point, without any major government stimulus in Thailand, I think this stock, the growth will be very lackluster, probably low single digit. Because without that, then the macro conditions is going to be quite sluggish because they ultimately already have a virtual monopoly in spirits. And without that moving, then the whole group earnings can't really move. So that's our general view on the stock. Next slide. I'll move on to venture, some stability creeping up. So for us, although the stock share sold down and the results were below expectations, we were actually generally a bit more positive from the results. So in terms of the usual positives, they generate a huge cash flow, about 254 million. So now their net cash on the balance sheet is almost 1.1 billion, but regretfully, they didn't raise dividends. So dividends, you look on the table on the left, interim dividends was unchanged, about 25 cents. You see two tables on the left. So although they give first half results, we normally look at the quarter. So you look at the second quarter, the earnings is still contracting, but for us, it's at a lower pace. So the negative is that since the last 2 years, I think the earnings and revenue continue to contract. So the profit used to be running per quarter roughly about 670 million. But this is still worse than the pre-pandemic. So it's almost 50% below pre-pandemic levels. The venture is guiding revenue to be stronger, so you should expect some improvement in the results. Now, we still think there's a contraction year on year, but at least half an hour is improvement. But for us, there are still some positive takeaways because the revenue decline that you saw here, the 6% in the second quarter is slowing down. And also their fixed cost is stabilizing if you look at employee expenses. So what it means that if revenue does pick up, they can get that operating leverage. And they also highlighted two growth products. One is the data center optical receivers. So basically, it's those fiber connections, optical fiber connections, to connect between data centers and also inside a data center. And they're also benefiting because the previous supplier was from China. Now they moved to Southeast Asia. Now they're using Southeast Asian manufacturers. The other product is consumer lifestyle, which we think is the Philip Morris e-cigarette. The growth there will be if the US gets approval for Philip Morris, then this will benefit them tremendously. So you have to wait for that part of the news. But in general, we will lower our profit and by 4-5%. But our target price, we nudge it up because we're raising our PE ratio because we think there's opportunity for this stock to recover, but the timing is not sure because their guidance is almost like now a guidance because second half is generally usually better than the first half. So I'm not sure what guidance is this, but anyway, we think that with a 5% yield, unless some investors are willing to wait it out, so then let's wait for the earnings to recover. Then I think this could be a stock for them. Next slide. So for Sembcorp, earnings visibility improve. Next slide. So the highlight so the earnings was. The revenue was within, but the profit beat our expectations, mainly net profit, beat our expectations mainly because of some of the jump in the associates and also jump in TPN. I'll explain later. But so the positive for us is that they continue to grow the attributable capacity. You can't see on the table on the left because you notice on the left the profit is actually down. But what happened was that they had curtailment of demand from China. But for us, the positive is that they are continuing to grow the capacity in renewables because renewables is the growth in this growth area for them. So let me just dial back because Sembcorp has morphed into a different company compared to last time. So for Sembcorp, around 60-70% of the earnings come from gas. If you look at the table on the left, so gas means they are not selling gas. It means electricity. So they sell electricity mainly in Singapore and it's powered, and they use gas as the feedstock. And then the other one is renewables like solar and wind. So going back to the negative, it was the weak gas earnings. But this was expected because they had less, because last year they had this very big gain because the merchant power, which is spot rates in Singapore. So in Singapore, electricity can be you either contract it out or you rely on the spot market. That means every day the prices will jump up and down like our stock market. Yeah. So last year they had this exceptional gain, 60 million. They also had this maintenance they had to do this year, and that they had to shut down the plant, so that also cost them about 50 million. But all this was well flagged out, but I knew it was a negative. So as the title of the report suggests, the good thing for them now is that 80% of this gas profit that you see here is already contracted. That means they're not on spot. That means they not on daily rates. They contracted some 1 year to some more than 10 years. This is compared to 50%. We raised our target price from $6 to 627. These are the way we calculate. We upgraded to accumulate and buy. Yeah, next slide. We'll explain to you how we view the stock. About next slide. Yeah. So in general, we think for 2024, we're not expecting much growth. So although second half will be stronger, but because without any new capacity, right? So the gas business or electricity business, electric won't grow because the only new capacity coming up is in 2026 when the new plant. So this part of the business, the 60-70% of the earnings will be very stable and they'll generate very good cash flow and stable because, like I said, it's already all contracted out. 90% of the capacity already contracted out. So that leaves the renewables as the main growth driver. But in the near term, they say second half will be weaker because seasonally it's weaker because I guess less wind and less solar. Because maybe less wind and less solar in the countries they operate. Although there's new capacity, but additional 2 gigawatt they mentioned, but most of it will be at the tail end. So you only get this benefit in 2025. So what it means is that renewables, there'll be a lot of new capacity, but you will see the revenue only coming in 2025. The other bits here, you see here, India, what they're just saying is that they are doing well in India, they're growing the capacity. Because renewables is about growing capacity to grow. I mean, it's not like suddenly there's more sun or the wind blow harder. So you need to grow capacity. And in India, what they say is that the competition is, the prices are higher, the more authorities looking to give out contracts. Used to be only one authority called SECI, now it's more. And they're also building a lot of expertise. So they are capturing more contracts in India. In China, although the reason why the demand was weak because of this thing called curtailment. So curtailment means is that let's say they generate wind power or there's a lot of wind, so they generate a lot of wind power, but the grid say they do not want, the grid is not buying from them because the grid say I got too much power because my demand is weak. So this is a near-term issue, but they said that they are still opportunity to grow capacity in China because there's excess equipment, everything is cheap. Government wants to promote renewable, and this is the only sector for the whole China is one of the few sectors in China that can grow, that they can generate economic growth. So the government is pushing for this. So in general, in a nutshell, for this urban, not important. Urban is just selling land, so that's called a small part, maybe 10% of the earnings. So in general, we think 2024 will be slow for them, but 2025 is where they can pick up growth again because of the jump in renewable capacity. Next slide. Move on to Keppel. Okay, I cover Keppel also now. But so the real estate, first half results was the real estate and legacy depressed earnings. So legacy is the old oil and gas. So the results was below expectations. Maybe if you see here, there's a few excludes. So the earnings was down 30%. But what the company will show you, so you look at Keppel's slides, they will show you this part here, the normalized PATMI, whereby earnings grow 7%. But when we take out valuation gains, because in the way Keppel show numbers is that they also include valuation gains as part of the profit. I mean, of course, it's not real. I mean, how can valuation gains be profit? So when we strip that out, you will notice the earnings actually down 25%. Mainly because you notice on the table here, real estate, sorry, it's a bit small for one, but the real estate actually came down a lot. But real estate, in their way they calculated is they got some valuation gains. Okay, I know it's complicated, but in general, the positive is they are still building up their asset management franchise. So just to recap, Keppel focus now is to build a asset-like business, something like a Brookfield, where they just manage infrastructure assets and then earn a fee. So that is doing well. The negative is that the real estate collapse. So mainly because they are still doing development, like a property developer in China, and also in Singapore. So that collapsed. The first half earnings was 2 million, basically zero. Last year they made 142 million, so almost impossible to fill this gap. So that's why you notice the earnings was below. We cut our earnings 20% mainly because of the real estate and the associate earnings, but we raised the sum and we lowered the sum of parts. So for us, don't expect anything strong operationally because it's going to be hard to fill this weakness in real estate. But what we think is that the share price is the monetization of REITco, which I think, that slipped my mind, I think could be 4 billion plus on the books. So it's no surprise. I mean, they already well flagged that they want to sell REITco, which is all the legacy REITs that they own. I think there are 7 REITs in there, if I'm not mistaken. Then they want to sell it together with Flotel and then bring the money back in, pay off one-off profits, and then pay off earnings and then deploy into the rest of the business. So that will be the main share price catalyst. Until then, I think the earnings will be quite lackluster too for Keppel. Next slide. Okay, the next one is Oiltek. So Oiltek, the earnings grew first 50%. Okay, so for Oiltek, for those who don't know, because it's a small cap, Oiltek, they generally, let's say they specialize in building facilities for palm oil companies. So you have palm oil, when you extract all the palm oil from the tree, you got to refine it. And then you have to fractionize it. That means you want to make cocoa butter, used for margarine, for for soap and all that. Then you call it fractionalization, which is another process. So that's what they do, and biodiesel plants. So the earnings jump is still running ahead of our 21% growth. The earnings has doubled over the last 2 years from all these reasons. The negative is that the order book has slowed down because last year was exceptionally strong. But the order book is still 2 years of current revenue. So the order book is about 400 million plus. So it's every year, if you assume 200 million is 2 years of revenue. We still think there's going to be growth because of all these reasons. There's still biodiesel blending, which means that a lot of countries still adding palm oil into their diesel. So like Malaysia, if you pump diesel, 10% of it is actually palm oil. In Indonesia, it's about 35%. But of course, there's also still consumption of palm oil, so people need refineries. Maybe not Indonesia because it's excess, but the largest opportunity for us will be if they are entering a sustainable aviation fuel. So that's something we will watch. There's no analyst briefing, so we'll give more details after the analyst briefing. No change in our target price or earnings. Next slide. So I'll just run through quick on our weekly. Okay, you notice a lot of blank space, not because I'm lazy, but generally too, but basically because there's not much key important news in major news in Singapore. So for Taiwan, the exports are still holding up, although slowing down. Then what supported the US market last week was the unemployment claims, which we usually don't look at because it's very volatile, because it's a weekly number, but the market took some comfort that the unemployment claims, that means people looking to get the unemployment benefits, was less, 233,000, below the market expectations of 240,000. So next slide. Okay, I'm just going to, okay, so yeah, this is from our morning note. I'll just summarize it where we give our weekly strategy. So we all know what happened. I mean, there's this big currency unwind, but the difficulty or the challenge was how to sequence the events, because how does currency, because the Japanese yen was weak, then how did it kind of cause even the US market to collapse? But what happened was, firstly, was when the yen collapsed, you had this selling in shares. So the Nikkei dropped 12%. And that's mainly partly because the shares on margin was at an 18-year high. So there's like 30 billion of shares on margin. So of course, when the equities market selling, we think also because of foreign selling, that actually caused the Japan equities to drop. But the thing is, how did it translate to the US? So we think it's partly because of the jump in VIX. So I think the key message here is that when the VIX jumped, it actually spiked up, it actually pulled down the whole US equities. So how that works is that there are actually many strategies that rely on VIX, but the easiest one to understand and the biggest one is this thing called risk parity and target volatility funds. So let me just explain it slowly. So risk parity means most funds, like all of us, we just look at returns. We just want to buy the fund with the best return and that's it. But such funds, they target volatility. That means they have a target volatility. Maybe the fund volatility is only 10%, just pulling a number. So, mainly because they want a high Sharpe ratio, but I'll explain that later. So when the equity spike, so when the VIX spike up, it means the equity suddenly the volatility of equities, let's say from 20% to 30% or 40%. So for these funds, what it means is that, oh, equities now is very volatile. I have to sell my equities to bring it down because I only have 10%, right? So what they do is they will have to sell equities and buy more bonds. So that's one of the biggest reasons why when you have a VIX spike, a lot of equities are sold even more. Yeah, there are others like trend following, whereby when equities volume volatility is low, then they'll buy more shares. And then when it spike up, they'll sell more shares. So the reason why you have all this is a bit more complex. I won't run through unless someone asks, but the reason why you have all these volatility funds is that everyone wants to raise their Sharpe ratio. So the Sharpe ratio, every fund you see this thing called Sharpe ratio. What it means is that for every, let's say, excess return, okay, let's say 1% of return, how much volatility or risk? So they want to optimize their Sharpe ratio, whereas so that to do that, they want to have very low volatility. Instead of targeting return like all of us, we just want to make the most money. But for them, they don't want to make the least volatility so that they can raise the Sharpe ratio. That means for 1% return, your Sharpe ratio, your volatility is very low. So that's the whole purpose of it. We created this thing called Volmergaden because there was this Volmergaden in 2018. So we call it Vol because in a nutshell, the volatility and the collapse in the yen that caused the whole market to pull. Not so much fundamentals, but more also the options of VIX that caused it to pull. Okay, I know it's very complicated. But so in a nutshell, for us, we are still defensive. At least for me, I'm quite cautious on the banks because there could be, if one rate cut is fine, but what if 4, 5, 6 rate cuts start to happen, then bank earnings might be impacted. So that's why we are overweight REITs. The core results coming out like Wilma, SC Engineering for reference. And for this week, we have 2 webinars like Miamel mentioned. We have Elite. If you want to buy a pound, if you want to buy UK REITs, and also we are seizing, if you want to understand more about China food security, because they are the ones that is involved in sweet potato. Of course, sweet potato, I mean, not many of us eat sweet potato, but in China, it's a food security issue because China imports most of their soybean from the US. So they need to diversify their food source. So that's why they are looking at sweet potato as one way to diversify into feed meal. That means use sweet potato rather than soybean as feed meal. So and if you want to know more, just dial in. These are the rest. We also have VinFast. If you want to know more about Vietnamese EV. Next slide. Okay. This just to give. I'm not a Japan expert, but I'll just show you some flavor of what happened. So, the table on the left is Nikkei. So Nikkei is in red. So you notice that when the Nikkei has been climbing together with margin. So in Japan, not unlike Singapore, they actually give like the amount of margin shares that's being margin. So you can notice the blue line. When the blue line climbs up, the Nikkei also be climbing up. So we don't have the latest figure, but I can only assume the margin would have collapsed because this one is only up to the week before the collapse. So that's why when you have a big sell down, obviously there'll be margin calls and with your high margin balance that you see here, 18-year high, the blue line here, that's one trigger. This one is just to understand why the yen was weak. So this is the blue line is the rate differential. So it is between so right now interest rates in US is 4%, the 10-year bond yield. Japan is 1%. So the difference is 3%. So that's how you get the blue line here. So when US interest rates is higher than Japan, then of course the yen will be weakened and the US dollar compared to yen will strengthen. So that's the red line. Again, just to illustrate what it means. So, but of course, currency is not just rate differential, there's also economics and all that. But this is one key factor if you just look at this chart alone, that when the interest rates in the US is much higher than Japan, then it will pull up the exchange rate. Next slide. So this one is just to show, okay, this is very complicated, but just focus on the December one here. So right now, the futures market is forecasting 4 interest rate cuts in 2024 and 4 interest rate cuts in 2025. It's only recently that they have the numbers for the 2025 futures. So you focus on the red line, which is the latest one. So their market is affecting 4.3% Fed funds rate. Now it's about 4.25, 5.5 by December of this year, and then 3.2 by December of 25. So this is the futures market, but you know, futures market is volatile. You can see the red line, it can be at this level, then can drop down to the blue line. But the market now looking at almost 8 rate cuts by the end of next year. But again, the futures market doesn't mean it's very, it's not very accurate, it's just very volatile. But again, this is what the market is pricing now. Next slide. I'll move on to Riverstone. We don't cover, but just to give you a flavor. So they are a rubber glove maker. Their earnings in the second quarter jumped 50%. Why they're doing well is because of clean room. So most of their profits, like 70% of it, comes from clean room gloves. That means gloves that you sell to semiconductor companies. Those that need a very clean room facilities like class 100, 800, that means virtually no dust, no anything that you use in hard disk drives and semiconductors, or even pharmaceutical. I will just run down to the bottom line, to the comment in view of time. So for them, the growth remains strong. And the biggest challenge now is currency because the ringgit is strengthening. To them, they said the demand will still be stronger. And why they can enjoy like 60% gross margins in this business, after all, it's just a piece of glove, is because most customers use only one supplier, because these gloves cannot have any dust particles and cannot contaminate, right? Because it's a clean room environment. So that's why they virtually, most customers, they're the sole supplier. And because this is a branded product, so that's why they're doing well. And the way they hint is probably third quarter will also be another year of growth. But of course, the market kind of priced in some of this growth. The PE is already kind of a 15 times PE. Okay, I think we can move on to Q&A, I think, in view of time.
Thanks, Paul. Let me take some first. There's one or two. Hold on. Okay, someone asked, hi Glenn, after this set of bank results, which local bank is your top pick for the coming quarter? And someone also asked about, whether or not is it time to accumulate good stocks like DBS and UOB. So I'll just answer both at the same time. So after this set of bank results, I think we have gotten more clarity on how the banks are going to fare in the next 2 quarters, right? Not just this coming quarter, the third quarter. So the banks have been trying to push more of their deposits, right? Excess deposits, which they do have a lot. So they do have a lot of excess deposits, mainly due to the loans growth not being as strong as they expected. So it's very low single digit. So they have a lot of deposits have been increasing. So there's this huge bunch of excess deposits which they are trying to store it into this longer tenure interest yielding assets. So they're earning so instead of pushing loans out where they can earn, let's say 5 to 5.5%, they are choosing and opting to store it into 4.5% kind of interest yielding assets, but at a longer tenure. So maybe up to 3 to 3.5 years, right? These are just the numbers I'm coming out is just sort of like a best guess estimate. I think only DBS says what the numbers are, but the other 2 banks don't mention anything, right? So these are just best guesstimates from what DBS has said in their call. Yeah. So what's happening now is that they are trying to extend their forecast and how long they can predict their NIM will be, which is why they are quite confident in saying, okay, our NIM is going to be at this certain level for FY24. FY25, I think not so much yet, but for FY24 at least they're willing to say it's all above, I think above 2%, right, for their NIMs, and it's relatively flat if you look at the first 2 quarters. So I don't think it'll move much. So that's one of the good points. The second good point would be that their fee income has continued to grow. I think all 3 banks are in the same situation where they are seeing more and more of their customers and their consumers shifting their sentiment away from just putting it into a lower interest fixed deposit. So instead of sort of refreshing their FD, right? They're taking the money out and then say, okay, why don't I put it into an investment product or wealth management product? And this will make the AUM, firstly, their base, the assets under management grow. We have seen that grow. And also their margins that they earn on this AUM, instead of it being in fixed deposit, where they earn very, very little margins, they are now earning a lot more because they are selling investment products. So that's one of the positives and the catalysts for the banks. So these two things will be quite positive going into the next few quarters. And then, but however, as Paul mentioned, they're also quite cautious because if there are 1 or 2 rate cuts, it's possible the banks are able to cope as they have managed to factor in this rate cuts. But if there's like maybe 4, 6, or 8 rate cuts, what will happen? So the NIM might take a larger hit than expected. And I think to answer your question, which local bank is your topic, I would say DBS still remains a topic because of their dividends. The other two are also very cautious on giving out too much dividends. They're saying 50% and they really stuck to that 50%. Whereas DBS, I think this quarter is a bit of a difference because they said they will not give it, right? Because it's they don't want to clash with the handover to the new CEO, right? So they said maybe the next quarter we could expect, or even the fourth quarter we could expect more dividends. Hopefully that they will keep in line with what they have promised to clients, to the investors and analysts as well during the investor day, and which is what they have reiterated, that they will increase their dividends. So that's one of the biggest positive. Now I think the dividends are around 6.4, 6.5%. Yeah, so it's gone back up, due to that correction in the share price. So DBS will remain one. Secondly, so let's answer the second question as well. The secondly is also UOB. UOB, what's the differentiator from UOB with from all the local banks, is that they have less exposure to Greater China. Greater China being mainland China and Hong Kong, right? They are mostly concentrated in ASEAN and Singapore and in the SME sector. So while they do have some exposure, let's say their clients are based in Singapore, ASEAN, but they have like properties in China. But majority of it is located in Singapore or like Malaysia, Indonesia, Thailand. Yeah, so if you are looking for a bank that, say, has less exposure to Greater China, then UOB would be the pick for you. But if you're looking mainly for growth and also for dividends, high dividends, right, and dividend growth, that would be DBS. I think there's one more about let me see if I can find it. Oh yeah, okay. And I think this is also going to be a hot topic. There are 2 questions regarding the DBS CEO transition. What to look for, and also how will the change in CEO affect? How will a change in CEO for DBS affect how the business has been running, say, in 3 years' time? Oh, okay, so more medium term, right? Okay, so for the new DBS CEO, just some brief comments. Firstly, she has been in the bank for more than 10 years, right? She followed Piyush, the current CEO, from Citibank, and then he brought her over and then said, why don't you join me in DBS? And she also, she mentioned during the call that she has always used DBS even when she was young, right? Because she's a Singaporean. So when she has been very familiar with how DBS works as a customer, firstly, and then when she went on to work, she also joined DBS, and she has been in many different segments. So she was in the private banking, now she's in IBG, right? Institutional banking group. So she's in plenty of the segments of the banks, of DBS. The only difference is that she hasn't really done the investor relations side, where she speaks to analysts, or when she takes on the media like Q&A regarding the financials. So that one can be trained, right? That's why there's a what's that called, where she works under him and shadows him for that about 9 months. Yeah, so that will be something that she can work on. But from hearing her speak and everything, I think she's more than capable of doing that. Yeah, so I think she's familiar with the bank. She's worked there for many years, and she has gone to many different segments and so helped the different segments grow. And I think she's really been groomed to take over this CEO role. Yeah. So that will be my take. In 3 years' time, I think the bank will just it will have to follow the current route that I think the board has also set aside. So all the decisions aren't made just by the CEO alone, right? Whatever the CEO makes has to be approved by the board. So I think even if she does something that, let's say, it doesn't sit well, the board will just reject it. So it's not so much just a sole decision of the CEO. So the board is still maintaining the same, right? It's not being changed. I think Peter Seah is still the chairman, Yeah, so that will probably be one of the reasons. It will be quite smooth going forward. Someone asked about HSBC or DBS be a better buy. We don't cover HSBC, but I think for now, I think DBS. I mean, if you look at the exposure to Greater China, and I mean, mostly in Singapore, I think DBS should be a better buy. And I will have to check on how are they different. Yeah. I think there's one more on iFast. I think they're just asking for the fundamental analysis. Just give my quick view. iFast is also benefiting, right, from this increase in their AUM. So they have seen their base earnings grow as well, and their base operating earnings grow. But however, most of their earnings growth came from this Hong Kong e-pension business, which they're targeting will surpass their targets provided, right? So I think for the year end, we could see even further increase, far over estimates. And the thing that's holding them back now would be that global bank. So they have the UK global bank. It's still loss making. Hopefully, it will come into break even by year end, and next year we could probably see some profits coming into that. I think they're really banking a lot on that because they want to be this global sort of like global company instead of just focusing on Asia. Yeah, so that's my 2 cents on iFast. I think that is all for me. Let me hand it over. Okay, so sorry, one more. What are the 3 banks' exposure to China and Hong Kong? So China, Hong Kong, there'll be Greater China. I think DBS is around 20%. OCBC is slightly higher, around 25%, and then UOB is below, like I think it's 5 to 10%. Yeah. So UOB does have the least exposure. The banks don't really separate it out also. The which one is China and which one is Hong Kong. Yeah. Okay, hope that answers the question. I will now hand it over to the rest of my colleagues. Okay, thank you.
Hi, I will just take the Lendlease question. Is the weak foreign sales in Lendlease staying in other property as well? Yeah, it definitely is a island-wide phenomenon, especially for the central mall, or just for the central malls. So, like Darren mentioned just now, Paragon REIT, in first half 24, their sales also down by 7% for the Paragon Mall. And the same phenomenon we observe in like Mandarin Gallery, their sales in first half 24 is also in the downward trajectory. Yeah, so essentially it's because like the pretty high base last year and the strong SGD, as the central malls are caters towards the foreign buyers. Yeah, so it's the sales is very much susceptible to the FX fluctuation. And yeah, hope it answers your question. And there's a Far East question. So why tourism related stock Far East Hospitality Trust Ascott Genting, their price seems not moving up much. Does summer holiday likely change that scenario? Yeah, so for Far East, so forward booking looks healthy at this time, and summer holiday definitely changes the game. The share stock performance is mostly because ADR is trending down. So for Far East, second quarter 24, ADR average daily room rate decreased by 1.3% year-on-year. And the pricing power for the hospitality rate this year is substantially lower compared to a year ago. Firstly, it's because there's not enough pent-up demand. Yeah, so all the travelers spent aggressively last year, but this year we see muted demand. Also, another is because the very strong SGD, it just erode the purchasing power for the foreign travelers. Yeah, so that's all for me. I'll hand over to the rest of my colleagues. Thank you.
Yeah, thanks, Jamel. I will just do some quick updates. So any update on Prime? Yeah, so Prime US REIT, their results is in 2 days time, so I have the results update then. But they just announced today that they finally managed to refinance their loan. So that is settled. So as a result, because based on our previous report, we had the two target price. One target price is if they don't refinance the loan, and another target price, which is a higher target price, is when they actually manage to do so. So as a result, now our target price will revert to the higher one, which is 0.18 cents. Yeah, so that's the update. We'll have the first half results update soon in 2 days time. Yeah, but the biggest headwind of the refinancing is over already now that they've just managed to refinance the loan. Yeah, so for logos, I'm assuming the ESR logos. So the update for ESR logos is that they recently issued an offer to swap their existing perps with new ones. So yeah, the results will be out soon. Yeah, I think so far the result is about half acceptance. Yeah, so that's the most recent update. There's one question on will Chinese spenders ever come back? Yeah, it's really hard to say because pre-COVID they were like big spenders at all these luxury properties like for Paragon, but because of like the property crisis and all these things in China and the weak consumer spend, so as a result, all these higher net worth Chinese, they've been affected. They're basically the ones that are affected by this property crisis. So as a result, the propensity to spend also is much lower as compared to pre-COVID levels. So it's really challenging in the next few months or perhaps even the years to come. So we think it will take some time before the Chinese spenders will come back to and even reach pre-COVID levels. Yeah, but Chinese travelers returning to Singapore, maybe we think might recover by next year, but the spending per traveler might not recover to pre-COVID levels so soon. There's a question on comments on Daiwa. Yeah, so for Daiwa Logistics Trust, they released their results. Yeah, so for MPI on a like basis and on Japanese yen terms is up, but because of the weak yen, is the total gross revenue is down and by about 10%, even though the MPI is up. Yeah, so but after the recent yen movements, that will definitely benefit the Daiwa. So yeah, that's basically all the comments I have. So basically, their portfolio is in Japan, they do not have much rental reversions. Obviously, they do not have any rental reversions. So the only time they can have some uplift is during the renewal cycle. Yeah, so for them, they are going to hit very hard by the weak yen. Yeah, hand over to my colleagues. Thanks.
Maybe I take this one, since I was on the banks earlier. Someone asked, in one, I think in the DBS slide, I stated the repricing of DBS fixed asset. Please elaborate. Yeah. So okay. So I think I meant to say that. Yeah, it's the fixed asset repricing. Yeah. So you're right on that. Okay. So I think you have to understand how the bank basically sort of works. I'll just give a very quick like 1 minute sort of how it works. They take deposits from the customers, right? And then they take these deposits and then they take it and then they lend it out to back to other customers, and then they earn that spread on the margin, right? So let's say they take in deposits at maybe 1%, they pay out 1% to customers who are putting their money with the bank, and then when they lend it out, maybe 4-5%, so they earn that spread sort of. So what the banks also do is that if there is a difference between the amount of deposits which they have, which is like maybe like that, and then the loans they give is only like that, right? It's a lot smaller. So what do they do with this excess money that they have? Yeah, they put it into fixed interest assets. So when I say fixed, I mean like fixed interest rates assets. So it can be like bonds, it can be treasuries. So they put it into this fixed asset. So what DBS was able to do in this quarter at least, and how they managed to increase the NIM, was that they repriced this. Maybe like it expired in the this second quarter, and then they put it into higher interest rates fixed asset. So they will put it in at a longer term now, for like maybe 3 to 3.5 years, instead of putting it in a shorter term for like 1 year, where they can earn maybe 5.5%. They rather put it in like 4.5%, but for a longer term where they can better predict how their NIM will move going into this year, the rest of this year, as well as the next year. Yeah, so that I hope that explains the repricing of the fixed asset. Yeah, so it's really basically whatever the excess deposits they have, and then they just reprice it to get a better pricing and also a longer term to better predict their net interest margins going into the rest of the years. Okay, thanks. I'll hand you over to the rest of my colleagues. Thank you.
Thanks, Glenn. I'll just take a couple questions before handing it to Paul. So this first question here, got any comments on NVIDIA? As of right now, not really. I think the only thing that came up in the last couple of months was that Supermicro's mentioned that the NVIDIA Blackwell might be delayed until 2025. We don't see any significant impact to our model and to this year's revenue. If anything, it'll be good for next year because you're just pushing out revenue from this year to next year. Given that demand is still very strong and still supply constrained, I don't think really it will affect that significantly. Of course, if the delay is more than 1 quarter and it starts to really push back into the second half of next year, then maybe that may open the doors for, I guess, maybe other competition to come in and take away some of the market share. But at this current point, we don't see any significant issues with it. Second one second one's on Google. Yeah, they had the antitrust. They lost this antitrust case about their search advertising or search placements. Essentially, because they own Android, what this refers to is whenever you buy a new phone, either it's Android or Apple, Chrome is front and center. This is because Google actually pays the Apple. For Android, they pay smartphone manufacturers for this placement. And so this was deemed as I guess, anti-monopolistic practices by the DOJ. In terms of how this will affect the business, I don't think that it'll be that significant because Chrome is already so entrenched with users. I think it represents maybe 80% market share. In terms of mobile, it's 90+% market share. So even if you take away, you don't allow them to place it there, most likely what people are going to do, they're just going to download Chrome anyway. So no significant business impact. The one key thing that we're looking out for, it hasn't been decided, is how much fine they're going to have to pay, or what significant penalties they'll be forced to do. Although this will likely take a bit longer because whenever the penalties come out, then they'll appeal. It'll be another 1 or 2 year process before anything gets done. Last question here. Any comments on SMCI results? Does it affect semicons in general? Yeah, so actually SMCI, the results were pretty good on the top line. I think they just missed a little bit on the margins. Just in case, SMCI manufactures like the racks, the server racks, the cooling systems. So they don't actually manufacture any semiconductor chips. They just manufacture they provide the infrastructure for these servers in data centers. So the only thing that caused the sell down was their margin base. But actually, when you look at their guidance for next year, it's actually very strong. Revenue, I think for 2024, fiscal year 2024, which just ended, I think came in at like 14 billion, 15 billion. I think they're guiding next year to 28 billion. So it's almost a 2x in revenue. And a little bit of margin expansion as well, above analyst estimates. So overall, actually a very, very decent set of results for SMCI. It doesn't really affect the rest of the semicons because they're a very small part of the overall ecosystem. Yeah. So I think with that, I'll hand it over to Paul to answer some more questions. Thank you.
Yeah, thanks, John. Sorry, let me just run through as much as we can in panel to Zin. What's your thoughts on the carry trade blowout? Do you think it's over otherwise? My own guess, I mean, nobody really knows it. This is all these hedge funds books, they won't be shown, and prime brokers also that carry all these trades probably won't share information among each other. But my only guess is probably largely done. because I don't think any compliance team, these hedge funds guys will let you continue with it. They probably have to close a lot of the positions, either because of margin calls or secondly, the risk teams will be like clamping down on them, asking them to unwind. Yeah. Usually after such a big blowout, after such a huge margin call, I think usually they have to curb a lot of this carry trades risk for the time being. And a lot of the models that they use to do the carry trade, because all this carry trades is based on historical data, on volatility too. So when this vol surges up, they also have to unwind because then it doesn't look so good anymore. Yeah. The problem is they use historical data, which probably not so accurate. Yeah. Okay, thanks. So we think in general, I think no one will know the actual number because nobody shares the prime brokers positions for the hedge fund positions, but we think it's largely over. Any reason why Yangtze shipping dropped? Any result? Yeah, we checked around shipping news. There isn't really anything negative. Container rates actually still climb up, but the results should be coming out. In Myanmar, when's the results coming out? Either today or tomorrow, right? Yeah.
No, it's Wednesday.
Oh, Wednesday. Oh, sorry.
Or
Yeah.
Tuesday.
Yeah. But we'll share with you somebody. Hopefully, we can put some comments on P3 once the results is out. Again, why Singtel also baffles me. I'm not sure. They actually came up with some good news. The Gcash, which is like the e-finance, digital, the fintech arm of their Philippines actually there was given like a 5 billion valuation. I thought that was positive, but I'm not sure. I didn't hear of anything. Again, the results also will be coming out soon, or more update, not rather than results. Okay, with the sale of Keppel, it's not Keppel Property, but I guess it's a typo. Fraser's Property to the parent via a share swap. FNN share price got up, but not ThaiBev. Why, especially with Thailand government dishing out money to its people and increase in consumption and tourists? Yeah. Okay. Yeah. I think my only guess is that I'm not sure why the reaction for FNN and not Fraser's Property. My only guess is that the likelihood, of course, FNN results is also strong, but there also probably the likelihood of privatization, maybe something that the FNN privatization could be easier done, because ThaiBev has been privatizing a lot of the F&B subsidies in Thailand. Oishi and Sembcorp, I think, yeah, in Thailand they've been privatizing. So maybe people think that with a valuation given they need to, if they want to privatize, it would be at a higher price. And that's my only conclusion, because the FNN results, the strong fundamentals was there all along. People could have just bought it all along. So yeah. So that's my only conclusion. Yeah. But for me, I would have thought if there was a privatization, my own view would be Fraser's Property rather than FNN, because they own Fraser's Property and almost 88%. So probably much easier to privatize the property, Fraser's Property, than FNN. That's my own view. Yeah. Can you provide some insights in the box? Yeah, so sorry, we don't follow, they don't do briefings. I'll try my best to see if I can visit them, because some listed companies just not interested at all. Unless you go to the AGM, that's the only time once a year they talk to investors. Apart from that, nothing happens. Yeah. So I'll try my best to see if I can get anything from them to try and meet up with them. So sorry, I don't not much provide on Dorset. How much more carry trades needs to be announced on one? Yeah, that's our answer or guess. I'd like to know how frequent the PSR stock coverage will be updated. Okay, so we usually write a report at the very minimum during the results. In terms of how we change the updated, as in what stocks we cover, what stocks we don't cover, it really depends, because we will add in more stocks when we initiate coverage, because that one takes a lot of downtime. It can take us almost a week or 2 weeks just to initiate a coverage on one stock. So that's why we initiate maybe only a few stocks a year, because it takes a very amount of time. But we change it when we decide to include one stock, or we will just when we initiate, we add it into the PSR coverage. Then when we drop coverage, then that's when we take it out. I mean, just very simple answer. Yeah, hope that's what you was asking. Yeah, US unemployment claims look overreaction to non-farm payrolls. For me, the unemployment claim is very volatile. but regardless, all the data still points to slowing job markets, because even when you look at the vacancy to unemployed ratio, the number of vacancies, they're all coming down. Even the unemployment rate is higher than pre-pandemic, like we mentioned last week. So, and most of the jobs, almost 80% of all the jobs the new jobs coming are all government related, which it's not economic sensitive. But the economic sensitive jobs are coming down. That means those are manufacturing services, those are coming down. So regardless of the data point unemployment claims, US is definitely slowing down, and it's already affecting the employment. My only guess now is just margins. Whether we get a recession, because if you look at the margin data, most of the US companies still have very strong margins, especially the big tech names. So, but once that come off, that's where we think the recession fears will be more acute, because logically that will mean then the corporates will start to want to shed more workers. They are still, so that one hasn't really happened full blown, but I think if you look at all the various recession indicators, the one that hasn't fallen off is probably margins, my own view. But that's why investors, we think at least should position for slowing US economy or global slowdown, because China definitely slowing down. That's 30% of global growth. So that's a done deal. So when with the US coming off, globally, we think everything will be coming down. Oh yeah, can you explain? Okay, Volkswagen is our own creation, but can you explain Volkswagen again, please? So what we're just trying to say is that it wasn't fundamentals that pulled the market down alone, although we had some bad data, but that's like not a surprise. It was the volatility spike and the yen carry unwind that caused the market to come down. So basically flows are the unwinding of positions, because in the near term flows determine the market, right? I mean, longer term fundamentals, of course, we all know that. So it's just to remind everyone, when you see such a big spike, to explain to everyone why this can actually pull down the market, because there are a lot of strategies that rely on volatility. I mean, that's the whole point of just writing that part down. For Oiltek, they declared dividend, but they didn't tell when. Yeah, I need to check. That's an interesting point. Let me just ask the management. Yeah, thanks for that. I didn't realize that too. So that was something I need to double check. Hopefully, I'm copy it. I'll try and paste it out once I get the answer from them. TSMC, can I leave this to John if it's semicon? How is Propnex doing? Is it likely to grow as interest rates decrease? Yeah, I think Propnex would be weak. I think APAC Realty numbers also, our ERA numbers have been weak. So the main reason is because new launches has been slow. I mean, they can't give you the official reason why things are slow. Of course, developers don't want to slow down any launch. So the approvals, for whatever reason you can think of, has been slow for new property launch. So that's why 40% the decline in transactions is about down 40% first half. So I don't think Propnex results will be strong. Interest rates, yeah, you are right. They have 140 million of cash. So lower interest rates might affect them a little bit, because they then won't, but they will still pay, because the one thing, the message the management always give is they want to maintain a strong yield. So one thing they might do is raise the dividend more aggressively in the first half, even though the earnings might drop, because that has always been their messaging. Because they don't really need the cash, right? They're so cash generative. They pay 50 million dividends and they generate about 60 million of cash. But maybe this year will be slower. Paul and team, recall your team was rather positive in SG construction activities. Please comment on Balster BSC. Yeah, so construction will be positive. I think that for the next 2 to 3 years. We did discuss it last week, but like we said, the next 4 to 5 years, construction activity will be very elevated. I think like BCA forecast, maybe 34 billion versus 28 billion the pre-pandemic a year. And the difference now is 2 things compared to the previous cycle. The first cycle is this time round, there's more green infrastructure. So in the past, we didn't have this thing called green infrastructure. So more rooftop, more solar, coastal protection, preparing for the materials is also green. So there's more green infrastructure coming in, including Terminal 5, the 2 IRs, more MRT, more walkway. the new port also, Tuas Port expansion. So that's one. And number two, for those who may not realize, the government didn't have such a large budget for infrastructure, but they have this thing called the SINGA bonds, the Singapore Infrastructure. Okay, I forgot the acronym, but this one gives them to raise money outside the budget. So they can actually, and then they only recognize the cost of this through the interest. So that's why I think they raised like 8 billion so far, if I'm not mistaken. But this is to allow the government to raise money and build infrastructure without relying on the budget, the yearly budget. So because this one, the only the interest or the depreciation, if I'm not mistaken, of this infrastructure is only in because the Singapore budget usually is almost like a cash accounting. What comes in, what goes out. But right now they can depreciate, they can only pay, they can like pay interest rate. It's in the Singapore budget report, but I just I can't recall the details. Okay, I think I'll pass it over to Zain first because not much time left. Yeah, sorry, Zain. Yeah.
Okay, thanks, Paul. I'll just share my screen now and move on to the TA. Yeah, so first up is there's a question on SRT, which is the CSOP IHS REIT ETF. So look at long-term trend wise, it's still downtrend. Recently, I think it's just been consolidating in the range, maybe between 70 cents or about 77 cents. So currently, I think nothing too much. I think we're just still likely to just hold up in this main range over here. Then the next one is on JJJ, which is the Lion Nomura active agent ETF. For this, I think recently there was a breakdown in terms of the range, a very tight range actually, between $1 to about $1.03 about there. Also not much volume. So I think for that, we could see maybe price do a bit of a sideways, maybe currently between 90 cents to about 97 cents area. Yeah, for this counter. Okay, next up, please advise what's the suggested entry price for OCBC and UOB. Okay. So first I'll take a look at OCBC. I think in terms of OCBC's chart recently, with the pullback, there was a breakdown below this uptrend trend, this blue color uptrend support line over here. Also, price is facing some resistance at this prior support of about $14.15. I think in terms of entry wise, possibly you can look lower. I think price could do a further pullback. First possible entry area could be at this range support around 1370. Next one be around closer to about 1340, which was actually another range resistance level previously back in March to April this year. So these are some possible entry prices to consider. Then for UOB, price recently there's also a breakdown last week of a few levels, which is at $30.40, $30.90. Price tried to do a bounce at this 29.70 level, but today we have a gap. Today there's another gap down below as well. So I think price could do a bit of further pullback. It looks like in terms of price action wise, hasn't stabilized. Next support level to consider would be around 28.90 this level, prior resistance back in April this year. Then another lower support will be closer to about 28.20, 28.30 level. And I will also talk about DBS. For DBS also, some breakdowns last week. Currently is facing some resistance at this 34.30 level, which was like the opening price when it kept down on last Monday. So I think price could maybe do a bit of a retest of the recent lows, which is around 32.70. Yeah, and then this 32.30 to 32.40 previous resistance level could be a possible entry level. We just retest this prior resistance for the three local banks. Okay, next one is Manulife US REIT. For Manulife US REIT, I think likely is currently in a bit of a consolidation pullback because the price tried to hold in the range between like 0.076, 0.082, but then there was a break below that last Monday. Currently, it did a retest but finding resistance. So with that, I think price could settle at a lower range between 0.068 to 0.072. So it could hit lower. Currently, we're seeing lower highs, lower lows. Next one is for ComfortDelGro and Jaffa. For ComfortDelGro, I think nothing too much. It's like price is still rather range bound, facing resistance at $1.42. But it's having support around 136, 137. So I think for now, likelihood is still quite range bound. Then for Jaffa, I think it's also quite range bound as well, probably between 30 cents to 35 cents area. There was a pullback recently towards the support and there was a rebound again. So I think price could if you just continue this range trade towards 35 cents. Then there's also a midterm resistance area at 33 cents for the time being. Okay, the next one is on some Hong Kong counters. Alibaba. For Alibaba, I think still quite range bound. Price is still facing resistance at around $78.30. So I think if it can break upwards, then I think we could see when price fill this gap over here to test about 81.30 next, which is confirmed with this this downtrend, this downward resistance line. So that will be next resistance level for Alibaba. Okay, then for Meituan. For Meituan, I think price currently doing some sideways after a breakdown of this standing triangle over here back then at 117. I think we will likely to see some more consolidation with a likely downside bias. Since price is unable to hold above this $107 level, which was the previous support level. So with that, we could see maybe price go down lower towards the next support level closer to about 96, 97 area. And for HKEX, Hong Kong Exchange and Clearance. For this, I think should be quite sideways for the time being. Overall, it's still in a downtrend, but currently its price is holding at the $225 support level. With that, I think we're likely to see some range bound going on. First resistance level at around 233. Next one is at around 238. So likely still range bound for now. And for JD, I think price is likely to still remain quite sideways. Recently, there was a breakdown of this 100 to 101 support level. Price came back to do a retest. Likely still finding some resistance over here. So I think price could remain still quite range bound between this 97 to 101 range for the time being. And then I'll move on to some the US names, AMD, Tesla, and Dell. So for AMD, I think price did a retest of a range resistance back 122. Currently some sideways consolidation at this previous support level breakdown at 135, 136. I think we could still see some sideways movement for the time being. Then if can hold this higher low at 129 over here, price could do some recovery upwards towards the next resistance area around 143, 144. Then for Dell, I think overall still facing resistance along this downward resistance line. Some sideways movement currently as it filled the gap previously around $93, $94. So we could still see some sideways move for the time being, with near-term resistance at this $98 level confirm with this resistance line. So I think quite sideways between 88 to about 98 for the time being. And for Tesla, I think price could do a bit of a rebound. So it did a retest of this downtrend channel support around 193, 194 recently. And then also the gap down last Monday, actually we did a retest of a previously double bottom neckline resistance already. So with that, price is currently a bit of a sideways. If you can break above the recent highs at 100, 203, we could see some bit of a bounce towards 213, 214, which was this breakdown level, as well as this channel resistance over here. Okay, then next one is Yangzijiang Dynamic and iFast. Okay, for Yangzijiang, I think overall quite range bound for now. It could be forming a potential head and shoulders with the neckline support at $2.24 since we had potential left shoulder and a head over here. For now, price is facing resistance around 250, which was this previous resistance level. So I think for now, the key will be to see whether if price is can form a higher low over here of above this 232 level over here. If not, you could possibly come down towards to retest this neckline support again at 224. Since we have this a bounce over here and price there was a sell down today as well. Then for Dynamic, I think Dynamic is still looking quite good. So there was a pullback towards to retest this previous range between 49 cents to about 51.5 cents. Also this uptrend support line as well. Then price did a rebound. The rebound was quite strong. Clearing the resistance at 56.5 cents, as well as above this recent highs at 59 cents to make a new high at 62 cents. So I think with that, we're likely to see some continuation of the momentum for the time being towards the new highs level. And for iFast, I think chart-wise is still quite weak since the breakdown of this ascending triangle support around 720 price just been downwards and consolidating for the time being. Some support at around 680 for now. I think so for now maybe some consolidation still with support around 670 from this swing low back end May to the recent lows, 670, 680. Some support there, then resistance will come in at around $7 about there. So maybe some sideways. Okay, then some other questions on Franken UMS, Samudera, and Aztec. Okay, for Franken, I think some recovery for the time being. Price following a breakdown of this 125, 126 swing low level. Today there was a gap up above it. So that I think price could do a retest of this swing high from around 137, 138. Then might do a bit of pullback again. And for UMS, price recently did a retest of the swing low at around $1 and finding some support around there. So I think for now, maybe some sideways consolidation. $1.05 to $1.07, this gap area is the resistance for the time being. For Samudera, I think Samudera, since this gap down over here and sell price is sort of stabilized, finding support at 77 cents. So that I think should be quite sideways for the time being. Being in the range with resistance around 82 cents to 84 cents about there. It should consolidate for a while. Okay, then for Aztec, I think for now should be still quite sideways. It did a retest of this uptrend, upward support line over here at 91 cents and then with a rebound. But with this sell down, especially after price broke above 99 cents previously, and then after with this sell down afterwards, I think that should be with this will act as a sort of resistance at 97 cents for now. So should be quite sideways for the time being. Maybe perhaps between 92 cents to about 96 cents area. Yeah, I think I'll just take some more Keppel's ST Engineering and Sembcorp Industries. So for Keppel, I think in terms of price action, it's still quite weak after the results that was sell down, then below this swing low at around $6. So with that, there should be some resistance over here above 6 to 6.10 area. Then next support level is around close to 580. For Sembcorp Industries, it did a retest of this swing low at around 445. That currently with a rebound back towards this breakdown area around 470. So that's still finding resistance over here. Likelihood we still likely to see some pullback perhaps towards 450 level for the time being, given this downtrend over here. And I'll take the last one on ST Engineering. ST Engineering, recently there was a pullback, but I think should be able to find some support at these current levels. Previously, this was a previous range resistance around 417. Also, there's this upward support line over here as well. So there's a confluence of supports that price could bounce over here from. Near-term resistance will likely be around 435. This range support breakdown level here. And so that's all from me. Thanks for your questions. Sorry I'm unable to answer all of them due to time constraints. But feel free to post in our P3 community group, and then I'll take it from there. I'll hand over time back to my colleagues. Thanks.
Thanks. It's already 1 p.m. Let me just take on this last one since there's thing on dynamic. So dynamic, the outlook still looks very positive because the industry is forecasting 7 to 8 FPSOs 2023-24. Then the estimates are for it to jump to maybe 11, 12 FPSOs per year. So what dynamic does is they do the top side of a FPSO. So FPSO, you can think of it like a floating refinery. So rather than bring all the oil you extract onshore to go and refine, so these are like floating refineries offshore. So that's what's helping the thing. What can move the price is there hasn't been any awards recently. So because their yard is full, so maybe the news flow could be new awards, and also the second half earnings should be able to repeat their first half. So so there's some of the drivers for the share price. Okay, with that, I'd like to thank everyone for your time, and sorry you can't take on all the questions. Today's a bit heavier because of all the results. But with that, thank everyone for your questions, your time, and wish everyone have a good week ahead. Thank you, everybody. Bye-bye.